Good morning, everybody, and thanks for joining us this Friday morning. My name is David Levinson of Nedgroup Investments, and I'm very pleased to have on the line Jeremy Lang of Ardevra Asset Management in London. Jeremy is a founder there and portfolio manager of our Nedgroup Investments Global Diversified Equity Fund. And yesterday, you would have heard my colleague Doug refer to the fund, and it's a pretty impressive performance to date. Jeremy will touch a little bit more in terms of what they've done from a pound sterling and dollar point of view, but for our South African investors out there, the fund has returned year to date around 30% for our local investors. Jeremy will chat a little bit as well about Ardevra and the firm in his first couple of slides, given that this is, I think, the fourth or fifth quarter they'll be reporting back to us. And as usual for housekeeping, please do post some questions. There is a Q&A function on the right-hand side of your screens. And what I'll do is I'll pose as many of those as I possibly can to Jeremy at the back end of the presentation. So without further ado, I'd like to pass on to Jeremy. Thank you, Jeremy.
Thanks very much. Right, I'll take about 15 minutes to introduce the business and remind you how we do things, and then I'll update you on how things have gone so far this quarter, and then we'll hopefully have time at the end to take some questions. Right. Oh, there we go. Right, the business, Ardevra. Very quickly, we're a privately owned partnership boutique. We run around 7 billion sterling, which I think is around 150 billion in rand. Sounds quite a lot. For clients all over the world. So as well as you guys in South Africa, we've got clients in Australia, North America, Europe, and the UK. We launched the business in 2010. And today we remain, as we were when we started, a private partnership, and we do things our own way, and we're pretty modest in our ambitions. Right, overview of the process and how the fund's built. It's a long-only global equity fund, bottom up, so we're very stock picky, and we're based on fundamentals, trying to understand what a business does and looking at reporting accounts. But we're a little bit different, I think, to other people in the way we use that standard information. We focus on psychology, and we're interested in why people make mistakes, us included. In particular, we think CEOs, people that run businesses, can be very risky and error prone unless they face environments that encourage them to be sensible. So our stock selection, from experience I've learned when I try and explain to people, is quite complex, but I'm going to try and keep it at a high level. We think stock prices are influenced by the behavior of broadly three groups of people: CEOs, other investors, and expert analysts. We think we're quite good at spotting unusual investment opportunities by recognizing and understanding the kinds of conditions where these three groups can behave unusually and make mistakes. We end up with two basic types of investment opportunities, either unusual growth businesses. We think most CEOs want their businesses to grow, but for us, what we're interested in is unusually easy growth. Often I think analysts and investors are more interested in growth levels rather than actually how easy it is or for how long unusual businesses can actually achieve the growth, and that's much more important for us. The second type is completely different, safe value companies. Most CEOs, in our view, like taking risks, and most of them don't like being wrong when those risks don't work out. But occasionally, if enough pressure is applied, CEOs can be coerced into wanting to de-risk their businesses. Often investors will have been traumatized during this period and won't trust the recovery plan when finally CEOs put something credible in place. What do clients end up with? Well, you end up with a fund with lots and lots of small positions, and it's diversified by style and sector, and we don't take big regional bets or have any favorite stocks. This focus on getting lots of small things right means our downside protection and our upside capture numbers are quite good, and we've been able to perform in a pretty wide range of market environments, which hopefully you'll see when we move on to the performance slides in a bit. Oh, actually not in a bit, right now, because it's the next slide. There we go. Oh, look at that. Right, performance. You can see from the chart that we launched the strategy in 2013, and it's delivered pretty good performance since then. The recent performance of the funds, which is shown in the bottom left-hand part of the box in the line chart shows you, I think, that we can cope pretty well with the wild market moves when they come along, like this year. We were able to provide some pretty decent downside protection year to date, but also we've been able to participate pretty well in the market as it's rallied. Longer term, if you look at those 3 and 5 year annualized numbers, you can see that we don't sacrifice upside capture in our desire to give you a bit of downside protection. All right, next one. Key performance contributors. Okay, before I talk about some of our winners and losers this quarter, let me give you a few thoughts on the environment we faced over the last few months. Until April, investor behavior, in our view, was dominated by fear from the arrival of a new risk, which we're all aware of, COVID-19. Stock prices were strongly influenced by data on that virus and its infection rates, and really corporate fundamentals was of secondary interest. But since April, the investors' reaction to worsening virus stats has been much more muted. That tells you that the market sensitivity to the virus has dropped a lot since the first wave. And that fits our general set of assertions about how we are trying to understand and explain the pandemic. In short, I think as the virus goes on, people, investors included, will become accustomed to it and bundle it along with all other risks and uncertainties that we all have to deal with in our day-to-day lives. And the true test of this will be when the stats of the ongoing second wave start to peak. But already I think you can sense from the way the market is behaving that it's starting in some sense to become a bit immune to this. Initially, analysts were pretty relaxed about the pandemic, but they really started to panic in February. And during March, they slashed their forecasts of corporate profits fairly indiscriminately. Since then, a lot of errors have appeared from analysts, mainly to the upside, in the impact of a lot of companies of the pandemic is generally, I would say, being framed as not as bad as feared. From a CEO behavior perspective, as we said last quarter, CEOs have faced their first proper, I would say, macro shock since 2008. But the shape of this shock has been very, very different and somewhat unique. As a result, CEO behavior has changed a lot since the start of the year as well. A lot of pressure has been exerted on them when they were previously pretty relaxed and risk-loving, and it's taken a little time, but many of them now, I would say, are unusually focused on how risky it is out there and how to make their businesses safer. So that's all, I think, a pretty benign backdrop, despite of all the alarming stuff that still comes out from the pandemic. Looking at our portfolio, as you know, we have 2 types of investment opportunities: the unusual growth and the safe value. And this quarter, those safe value names have been particularly interesting. I break this set of groups into stocks into 2 groups really. One are the group which we kind of frame as the COVID changes everything group. These are things tied to eating out and tourism and air travel and so on. And then there's the second group, which are companies where the CEOs were pretty quick to respond to the general economic shock and which we're experiencing as a result of the lockdown. And they're a bit more, if you like, classic sort of cyclical things. The COVID changes everything group haven't done as well, which isn't surprising given that we're in the midst of that second wave, but investors are much less sensitive in general to COVID, I think. These particular, it makes sense, I think, that investors are still anxious about the COVID changes everything stocks, but we're pretty confident that as this second wave peaks, and as we emerge from COVID, that these types of stocks will start to represent a really interesting opportunity. The second group, if you like, more classic cyclicals, the companies that have been duffed up a bit by the macro shock, they've continued to really recover very well since April. Right, let's have a look at some of our stocks. If you take a look at the table, I'll just highlight a couple of the points before taking you through some stock examples. That PF weight column shows the proportion each stock represents in the portfolio. So what you'll see from that is that they're all pretty small. Our profilers have lots of small bets. The excess return contribution column shows you that our biggest winners, they only contributed about 0.5% of total performance in the quarter. What you should take away from this is, well, first of all, people don't die of excitement when you read our quarterly reports. We don't rely on a couple of big winners to drive our performance, and we think this makes us much more robust and consistent, but it obviously doesn't make for a very exciting story. Okay, right. Let's just pick out a couple of stocks, one which did well and one which did badly, and we'll walk you through them. So one which did well was Navistar, which is a US maker of trucks and diesel engines. It sits in our kind of safe value bucket of stocks. Navistar has had a pretty checkered history, which is kind of what we would expect from this sort of opportunity. It's squandered billions of money on trying to develop its own proprietary low-emission diesel engine, and which ended up looking like a Betamax in the VHS engine world. And then in an act of irony, the company has been partially bailed out by VW, which is kind of when we got interested in it, who were interested in using Navistar as a bridgehead for their expansion into the US. This bailout of Navistar gave them a bit of room to really properly restructure and reduce risk in the business, and an opportunity which didn't have before to really drive down costs by doing a procurement joint venture with VW. So it had, for us, kind of all the classic things that we get interested in: pattern of past trauma, and then a kind of anchor point which sort of triggered a lot of stress for management, which really forced them to try and de-risk their business and focus on survival. And that's a kind of fertile ground for buyers. We've had a bumpy ride with that since we first bought it, but we got our sort of final payback in September when VW finally decided they wanted to move to full ownership, and take advantage of the progress that Navistar had made, and wanted to roll it in and merge it with their other truck division. So they've offered us a nice amount of money to take those shares off our hands. So we'll move on. Then an example of a stock which has done not so well for us is International Consolidated Airlines, which is the old British Airways. It's a holding company for lots of airlines sort of based in Europe, including British Airways, Iberia, and Aer Lingus. That again sits in our kind of traumatic value type stocks, but it I think typifies the COVID changes everything sort of narrative, which I spoke about a little time ago. It's been clobbered by the fact that we've had a series of lockdowns, which has made it very, very difficult for people to fly, particularly in the long haul market. And there's a lot of anxiety and skepticism around this business because of obviously the financial repercussions and not being able to do what they normally do. But this has triggered a really significant restructuring process where they've absolutely slashed costs. They've taken very, if you like, difficult decisions for that business, which they've been sort of putting off for quite some time, which has meant that they can really radically reduce their cost base and their capacity, where essentially they're just hunkering down and making sure that they're going to survive. And in our view, COVID doesn't change everything. You know, demand will come back, and I think they'll have a lot of upside leverage as things begin to get back to normal. Okay, so let's wrap up. So if I can just leave you with a few things. We think we're unusual. We're interested in psychology, and we don't trust company management. It's pretty much, I think, an all-weather approach. We don't perform all the time, but we're pretty good, I think, at coping with most things that can be thrown at us because of this unusual mix of stocks that we have, and we don't take big bets. And then I'm going to pause there, but should I have moved through any more of the slides? No. Okay, so I'll stop there. Thanks. Oh, yeah.
Excellent.
Sorry, there we go. I should have moved through some more of those slides. Oh, I could do it. Right, anyway, there we go. Hopefully that wasn't too confusing.
What I can do, Jeremy, is I'll direct a question at this specific slide, but yeah, I know you prefer to present off the cuff, so I appreciate you following a more formulaic process with us this morning. Thank you very much. We had a few questions come through, and I'll try to ask them in chronological order as you went through your presentation and the rest. The first question is around your philosophy. So ultimately, above all the biases and errors that are evident in the market, what you look for really is sensible management behavior. And is this a non-negotiable for you?
Yes, that's right. That's where we start. So we have this kind of structured approach to developing ideas, where we kind of scan around the market, looking for things that look unusual from various angles first. But then when we start doing our proper research, where we start is what kind of business is it, and what's the CEO behavior like now, and can we build a case that what he believes about his business and what are his plans for that business at the moment, are they credible and sensible? And if we don't get the right answer to that, that's as far as we go.
Okay, thank you. And we had the question asking about how many stocks you have in the portfolio, and you've taken us through a number of a couple of the contributors and detractors. But what became clear is obviously that there is no favorite child. Why is it that you don't have any favorite stocks? Maybe you can give a little bit more of the rationale behind that.
Yep. So the investment process is built on this idea that there are three key groups of people in the market: investors, CEOs, and research sell-side analysts. And stocks get interesting when those people start making mistakes and start behaving in a biased way. But we're not arrogant enough to believe that somehow we're independent of all of this. I mean, the interesting stuff that comes out of psychology is that even if you understand a lot about the mechanisms of error and bias, that doesn't stop you from making those mistakes yourself. You can do a few things to try and make yourself less error prone, but you've always got to expect that you're going to make poor judgments and be sucked the wrong way. So our process is sort of partly designed to try and reduce slightly, the errors that we make, but also recognize that we do still make a lot of errors. And so where this is going is the reason why it's a good idea not to have favorites is because it makes it easier for you to let your errors go. When you have favorites, you can be quite colored, I think, by the way you view new information as it comes in, because you want that information to back up why you really like the stock. So trying to avoid getting sucked into that, I think, gives you a better chance of being a little bit more objective when it turns out that you're wrong. Also, having a lot of positions, that also helps as well. If any individual position is only around 0.5% of your portfolio and it starts to go wrong, it hurts, but it doesn't hurt so much, again, that you get into that emotional turmoil of, or can I cope with selling it at a loss, locking in the negative impact on the portfolio, because any individual decision, when you get it wrong, doesn't do too much damage. And again, I find that emotionally, it's kind of easier just to accept you're wrong and move on.
Mm-hmm. Okay, thank you. And then I mentioned at the beginning of the call the performance of the fund, and you did have a slide on that. And there are winners across multiple sectors and varying environments, as you would see through that line chart. Maybe you can highlight any environment where investors would expect the portfolio to struggle.
Yeah, there's a couple. I think it's mainly because of that point that you made earlier of the non-negotiable thing on management behavior being sensible. There are market regimes where basically everybody loves risk. And they want leverage, and they want, sometimes that's leverage to a powerful recovery, or sometimes it's leverage to what they perceive as a fantastic growth opportunity. And I think in those periods, flakier businesses and riskier CEO behavior can get rewarded. So those would be the kind of environments where we would, I think, struggle. But generally, it's a more struggling to keep up kind of problem, I think. Second type of environment is we have very, very few financials. We don't invest in banks and insurance businesses, basically because we don't really trust them. And there are kind of certain environments where they can just do well because of what they do. But again, so we'll lag in that kind of environment. Third type of environment, although actually we've been able to cope with it, is when there's a big divergence between the way mega caps are behaving and the way the rest of the market is behaving. And that's a function of, because we equally weight everything in the portfolio, we're systematically underweight the really big stocks in the market. But as you know, that's something we've had to cope with for quite a few years now, and we've still been able to overcome that. But sometimes, just when you've got a handful of stocks just going up and nothing else going up, we would expect to struggle in that kind of environment.
Okay, thank you, Jeremy. And we had a question come through on the investor and the the investor bias and the analyst bias chart. So would you be able to maybe go back to slide 7 for us quickly? I think it was a previous slide.
Yeah, sure. Oh, there we go. Yep.
Yeah, sure. So obviously the lighter green there is the investor bias stocks, and then the analyst bias and the darker green, which the fund was tilted, I guess you could say, since Feb 2015 in favor of the analyst bias stocks. And the question says, just looking at the slide, the portfolio does appear lighter on the value stocks going into the crash, and I guess that's referring to the COVID crash at the start of this year. Then we can now see you have found the environment more conducive to those types of stocks again. If you could maybe describe a little more the conditions that arose around July and August, and was it a case of just finding more value opportunities?
Yeah. So first of all, spot on observation. We've been carrying, I would say, a kind of a skew to safe growth for quite some time now, and that's partly because we found it just more difficult to find credible recovery restructuring type management plans, which is what we need to be comfortable with a more value type stock. That's partly because there's been a kind of structural environment where winning and losers have kept losing, and a lot of businesses have been disrupted. But it's also partly, I think, from our experience that investors are most prone to getting over anxious and overreacting to bad news when you've got a general climate where everything is tough, i.e. more when you get more of a macro shock. Also, you've got a better chance of finding businesses where essentially the reason why investors are anxious is at least partly transient, i.e. it's not going to last forever. And again, that's more associated with when you get a kind of random external shock come in. And so we've been sort of sitting, I would say, waiting for that kind of environment to unfold, and that's really the opportunity, I would say, of COVID, is that as COVID really ripped through, it suddenly created this environment where lots and lots of perfectly reasonable businesses without structural issues suddenly found life hard, and they were forced into recovery restructuring plans. And as I said earlier, that threw up a whole group of particularly, for us, interesting and new opportunities, which are in this COVID changes everything group. And so it was our desire to take advantage of that unusual environment, which is that flip, which you see, which basically happened in sort of April time, where we thought, you know what, for the first time in quite some time, there could be some opportunity here. And then we'll see how that plays out. It's not a structural bet for us. It's all value stocks for us are always about buying other people's extreme anxiety and then expecting that anxiety to unwind because there's something transient which is causing that anxiety, which with time will disappear. But ultimately, these things tend to play out over maybe not a year to 2 years, and then generally you're back to normal. So yeah, that's where we are at the moment.
Okay, thanks, Jeremy. And you mentioned the term transient in your answer there, and I know you ran a survey across your company around their behavior changes during the lockdown, and some of them being transient and some being a little bit more permanent. And then you go on to speak a little bit about what that means for certain stocks and sectors. Maybe you can touch a little bit on that as well.
Yeah, I think that for us is the key debate at the moment, as we're sitting in the sort of teeth of the pandemic. Is you can clearly see that behavior has changed across large sections of the population, which has caused some businesses to do spectacularly well and a lot of businesses to really struggle. And really the key question is how much of that is gonna change and how much of it isn't. How much of it is going to be just, well, the moment COVID settles down or we get more normalized to the risks, are we just going to revert to how we behaved before? And how much of it has sort of prompted us to rethink things a little bit more deeply and go, you know what, I'm not going to go back to the way I behaved before. Because that's really the crucial difference between what's a transient source of anxiety and what's a permanent source. And so to try and get a handle on that, we thought it would be interesting to just ask everybody else in our business what they, 5 things that they have changed, which they are quite pleased that they've changed and wouldn't go back to, and 5 things which they've changed which maybe they're forced to be changed by the pandemic, which they're really quite desperate to get back to, as a kind of to give us a sense of the sorts of businesses which maybe are transient versus structural. And I think what really jumped out at us when we did that survey, and we've got a reasonably eclectic mix of people here, is that I would say there's one thing that appears to be a desire, certainly, to be a permanent change, and that's work from home. Almost even the workaholics amongst us basically had to admit that having a little bit of work from home was kind of nice, and that it seems to us is highly likely to persist, and that on its own, there's a lot of knock-on effects to that, to do with the location of businesses close to offices or not. And what that means. Also, it means if you're spending more time at home, you're going to be probably spending more money on your home, and you're going to be more engaged with your local environment as well. So I think there's a number of interesting things which come out of that, but really it ties back to this, when it's highly unlikely a lot of us are not going to go back to 5 days in the office. So that I think a lot of when you think about the permanent changes, they have some kind of logical tie back to that. The other ones, the transient ones, were everybody was really desperate to get back to going on holiday and getting out and socializing and eating and drinking with other people. And so that's all the stuff which we've been forced to not be able to do now, and we've had to come up with poor substitutes like Zoom pub quizzes and all that kind of stuff. And everybody is basically desperate to get shot of those and get back to normality. So it seems to us any business that is basically tied, and again in some way directly or indirectly, into those activities, that the trauma they're experiencing now will pass. And so as long as they can survive this period where they're not being allowed, if you like, to do what everybody wants them to do, there's an enormous amount of pent-up demand, and that will come back. So those for us are the obvious recovery plays. And then within that, there's some interesting stuff to do with the work from home is going to change the structure of the economy, and if you like, businesses are in the wrong places for certain things, which is going to cause a bit of dislocation. But to us, those are essentially the two big themes that jump out.
Thank you, Jeremy. And there is the big elephant in the room, which was the presidential debate last night in the US, and I was thinking about avoiding this question, but we have had one come through on Trump, and I'm sure you get it quite a lot because he really fits the bill of maybe the type of CEO that you would either avoid or short altogether. So maybe your view on him as a leader, and then is there a read-through for market anxiety at the moment? And I know before this call you had some really interesting comments around the polling in the US and drawing on conclusions on what happened in Brexit as well.
Okay, all right. So him as a personality type, he's exactly the kind of personality type we would avoid and not trust when we were, if we were engaged thinking about investing in a business. He's a very extreme form, I think, of the kinds of people that want to run businesses. And he's a good reason why Plato said that, you should only have a certain type of person to run your country, and you definitely don't want an ex-businessman, because they don't have the right, should we say, moral fabric to be put in a position of leadership. So I don't have a particular strong aversion to him as a person, but he does represent for me a lot of the very dangerous things that I spend most of my daily life trying to avoid, if you like, from an investment point of view. At the end, though, you've got to accept that he's the result. He's not a dictator. He's the result of a democratic process. And so the fact that he is able to run a country like America does tell you about how unhappy a lot of Americans are with the status quo. And I think why a lot of Americans like him is that they see past his personality and they think he's basically he's good for less government involvement, more for personal liberty, and they think he's pro-business and pro-enterprise. And that's why, as we come to the end of his first term, there was a lot of anxiety when it looked like Trump was going to win. It's turned out, from an economic point of view, not to be too bad. What we obviously see is that the kind of leader is completely ill-equipped to cope with any kind of shock like the pandemic, which requires proper leadership. But the American economy and American society is amazingly robust and adaptable, and it's what I've learned from being an investor globally for a long period of time. Is there's this amazing flywheel of enterprise and get up and go in America, which is very unusual, which you just don't find in any other part of the world. And so that ability for Americans to adapt and deal with things and move on is quite amazing. So that leads me to the final part, which is, does it really make that much difference who's running the country there? I don't think it does in the end. It makes a lot of difference when you get these kind of pandemic shocks. And sorry, we've just got a fire alarm going off here, which stop. And it can have a big impact on the more marginalized areas of society. But from an investment point of view, generally presidents come and go, and it doesn't make that much difference. So in the end, that elephant in the room for me is not much of an elephant. It doesn't really have that much of an impact. It does short term, it'll create lots of volatility, but ultimately it won't make much difference. Then on your final question on the polls, there's a lot of anxiety, I think. A lot of people want Trump not to win, because they don't like him as a person. And so there's a lot of anxiety given the prior election cycle when Hillary Clinton was ahead in the polls all the way up to the end, that people now don't believe the polls. Our experience here is that we had a similar situation with the Brexit cycle and then with a couple of election cycles here where people didn't trust the polls. But the last election we had, the result was almost bang in line with the polls. And that's because, like most things in life, things adapt. If you're a pollster and you find your polls were rubbish last time round, you don't just sit there and do the same things. You try and change things to make them more accurate. And so I do think that a lot of lessons have been learned from the last time and why those polls weren't accurate. And so I think the chance of them being inaccurate this time are much, much lower. But this is a classic case of bias and anchoring. People now anchor very strongly to that one instance where polls really failed, and ignore the fact that most of the time they're not a bad representation of what's going to happen. So my gut on this is that the polls will probably not be too far from the truth this time around.
Thanks very much, Jeremy. I hope for your sake that was just a fire drill and not a genuine alarm. But you're like we've used up our 30 minutes here, so we're a little bit short in time. So if you do need to evacuate, you're welcome to do so. But thanks for spending the morning with us today.
All right, lovely. Well, thanks for your time as well, and good luck until we have a chat next time.
Cool, thanks. And I'm sure you got everybody dusting off their old philosophy textbooks from university and reading about Plato.
Yeah, like
power corrupting and absolute power corrupting absolutely. So yeah, thanks for your time again this morning, and thanks to everybody for dialing in and joining us. It is a new type of proposition for South African investor, the behavior finance style fund. So if you do have any questions, please do get in touch with your Nedgroup Investments Relationship Manager, and we'll happily furnish you with any more information on the fund and the ins and outs and the nuts and bolts of how it works. So thanks again for joining us today. This concludes our week of Global Fund Report Backs. Do stay safe and have a good weekend. From myself and Jeremy, take care. Goodbye.